Time for the ETF report. Our guest says as ETFs proliferate and often get more complicated or more aggressive, leveraged, it's important for investors to understand the holdings in the fund before buying in. Let's get more from David Bahnsen, CEO of the Bahnsen Group. David, thanks very much for joining us.
Thanks for having me.
Is there a risk with such a bewildering variety of ETFs and so many? I mean, there are thousands of the things. People are not always clear on what it's holding?
No, they're not clear on what it's holding often, and they're all not clear on what the main objective of the particular ETF may be. So in the simplest forms, just finding passivity and a basic index replication is pretty simple. And then, as you know, it gets far more complicated from there. And having some understanding of what's under the hood is more important than ever.
One fantastically popular product here in Canada is these covered call ETFs, and I think you have them in the States as well. They're designed to improve income from a fund, but in some cases they have underperformed a straightforward ETF holding equities.
They have, and there's a lot of ETFs that have a sort of concept or theme to them, but then the underlying ingredients have more complexity, and so you end up with what would be like a tracking error relative to the performance, and that has to do with the mechanics of how they go about doing these things. They're not so simple, and so it's important for investors to understand how those things work, and then they can understand where there may be a delta between the underlying performance and how their own ETF performs.
Let's get on to one category that you are interested in, and you do offer one in this area. These income ETFs designed to funnel dividends, for example, to the investor. You have one example that you think does a pretty reasonable job, and it's from USCF, and they say, invest in what's real. And this one is the USCF Midstream Energy Income Fund. Why do you think this is something investors should consider taking a look at?
Well, it's interesting that for all the ETFs that we're talking about and how wide the space is, I'm utterly shocked there isn't more competition for active ETFs in the midstream energy space, where you can get the ability to actively manage with Canadian companies, MLPs, American corporate, different categories of oil and gas pipeline type companies at great income, but growth of income, and have it be actively managed. That's what this UMI, the ticker UMI does. And I think that diversification and proactive management has created some phenomenal results.
I'm just looking at some big holdings, pretty recent. Actually, it's a little dated. It's September 30th, but it gives us an idea. Energy Transfer, LP, Enbridge, our own Enbridge, and Williams. So it looks like do some of these LPs pay out income that's more like interest rather than dividends?
No, these are going to largely be pulling through to the underlying investor as qualified dividends for the states, and some of this is of course sheltered. The ETF provides some tax benefit, but again, in the case of that UMI, what you're doing is avoiding a situation where it's all American corporations without MLPs. And then you're also avoiding something that's only MLPs, and that diversification gives a little more bandwidth in the way American ETFs are set up.
Now, you offer one yourself. It's the TBG Dividend Focus ETF. The big part of your philosophy here is don't focus on what the yield is, focus on whether the dividend is growing.
And I think that what I would say is we want to buy companies that at purchase, our blended yield across the portfolio is going to be more than double the S&P 500. But then we're buying the companies because we believe they can grow the dividend and will grow the dividend year after year, no matter what. And we just don't believe that passive ETFs that do that have done it very well. They're subject to an awful lot of dividend cuts over time or very low yield. And so the active approach to dividend growth enables you to get in front of companies that their dividend may be vulnerable as business conditions change. That's what we do with the TBG ETF.
The yield I'm seeing is about 2.5% or maybe 2.6%.
Yeah, but that's a little misleading because in reality, the absolute yield is about 3.7.
Okay.
But with the ETF, the investors at the X date are sharing all the dividends from the quarter before. So TBG has had huge asset growth, and so it ends up having all the dividends collected be shared amongst more shareholders. So you become a victim of your own success. That, of course, is true of all ETFs, just the way they work structurally. But if you were to take the absolute SEC yield and minus fees, it's in the high threes.
I know, and yield is always a complicated subject, and I see it's got assets north of $200 million US. According to my Bloomberg screen. Just finally, I mean, you launched it, I believe, in 2023. It has underperformed the S&P 500 since then, but of course it is kind of apples and oranges. The S&P has been driven by companies that pay very low or no dividends.
Well, that's right. And so we've run this dividend strategy for 20 plus years. We run about $9 billion at my firm. And we created the ETF. It just launched in November of 23. And so it's only a little over 2 years old. And of course, in 2024 and 25, you had the AI Mag 7 type trade that did quite well. So we would never benchmark this against something like the S&P. But I will say, in 2022, the S&P was down 19%. And our dividend growth strategy was up 5%. So it's a very low beta, and last year was a high beta type year. But yeah, the strategy is going to lean into energy, into defensives, where there's better dividend growth. And that a good dividend growth is certainly not there in the Mag 7. Now, we're only a few weeks into the new year, but you look at year to date, and it's outperforming the S&P by 350 basis points.
No. Yeah, and you see, you're pretty diversified. You got a bit of tobacco, you got retail REITs, integrated oil and gas. You got a very wide spectrum of companies in there. David, thank you very much indeed for joining us.
Thanks for having me.
David Bahnsen, CEO of the Bahnsen Group.